What if I told you that the most important number in the world was a lie? Not just a mistake, not a rounding error, but a deliberate, calculated fiction repeated every single day for years, a lie that quietly shaped the cost of your mortgage, your student loans, even the stability of the entire global economy. Well, this is the story of that lie, and the fallout it's still being felt to this day. At the center of all this is a man named Tom Hayes. He's this brilliant, pretty divisive trader who became the public face of one of the biggest financial frauds in history. Back in 2015, he got a 14-year prison sentence. But then, in a twist that shocked pretty much everyone, a higher court just quashed his conviction, which forces us to ask a really tough question. So who was Tom Hayes? Was he a criminal mastermind, the ringleader of a global conspiracy, or was he a scapegoat? As the British MP Sir David Davis puts it, was he just a convenient target sacrificed to make the public feel better after the 2008 crash? This is the central conflict we're going to unpack right now. Answering that means we have to unravel a really complex story. It's a story about a single number, a totally broken system, and a legal battle that really challenges our whole idea of what a financial crime even is. So let's start with the number itself. Okay, so before we can really dig into the crime, you gotta understand the weapon. And in this case, the weapon was a number called LIBOR. For decades, you could argue it was the most crucial number in all of finance. So what is LIBOR? Well, put simply, it was the average interest rate that a select group of the world's biggest banks estimated they would have to pay to borrow from each other. Think of it like this. A grocery store has a wholesale price for milk before they mark it up for you. Banks have a wholesale price for cash, and that price was supposed to be LIBOR. And the scale here, it's staggering. LIBOR was the benchmark for over $300 trillion in financial products around the world. I mean, that's a number that's almost impossible to get your head around. It was baked into everything, from super complex derivatives all the way down to everyday stuff like mortgages, business loans, car payments. A tiny, tiny little nudge in this one number could literally shift billions of dollars around the globe in an instant. You see, its whole purpose was to be an honest signal, a kind of daily health check. If banks were feeling confident and lending to each other on the cheap, LIBOR would be low. That signals a healthy, trusting system. But if they were scared, if they thought another bank might go under, they'd charge a higher interest rate. So a high LIBOR was like a fever warning for the entire global economy. And this right here is the fatal flaw, the core vulnerability of the entire thing. The world's most important number was not based on facts. It wasn't calculated from actual real trades that you could check. No, it was an estimate. Every day, banks were asked a hypothetical question. At what rate could you borrow money? And that made the entire $300 trillion system completely reliant on the honesty of the bankers punching in the numbers in what was later called a regulatory wasteland. So now that we know what LIBOR was and how, fragile its whole foundation really was, let's look at exactly how it got exploited. The manipulation really boiled down to two main reasons. First one's easy. Pure greed. Traders like Tom Hayes had these enormous bets on where interest rates would go, so they just asked their bank's LIBOR guy to nudge the rate a tiny bit up or down to make their trades pay out. The second motive was basically institutional fear. During the 2008 crisis, no bank wanted to look weak, so they started lowballing, submitting fake low numbers to seem healthier than they were, which completely deceived the market. And listen, this was not some subtle, hidden conspiracy. It was brazen. I mean, internal chats show traders just openly asking for favors. This email from a broker to a UBS trader literally said, "Be a hero today," and asked him to keep a key LIBOR rate flat. This was just normal. The collusion was so common, it even had nicknames. Traders and brokers would refer to their little groups in these weird congratulatory terms, like the Three Musketeers, misspelling it all, celebrating how they were working together. It just shows you how routine this all was. The language they used was almost cartoonish. A trader who successfully pushed the rate around would be called Superman. That's not the language of a secret plot. It's the language of a corporate culture where this was just fine, even something to be praised. And this is the point right here. This was not the work of some lone wolf. The investigation into just one bank, UBS, found at least 40 people, including 11 managers, were directly involved. And another 70 people knew about it because it was all happening out in the open, in group chats and emails. The final report said the whole thing was pervasive and considered normal and acceptable business practice.
Well, an open secret like that can't stay secret forever. And when it finally exploded into a public scandal around 2012, the consequences were seismic. Regulators, prosecutors, they all moved in, and the price of the lie started to come due.
The banks themselves, they paid dearly. The fines were just staggering. Deutsche Bank, $2.5 billion. UBS, $1.5 billion. Barclays, Citigroup, RBS, billions more. All told, the financial penalties climbed to nearly $10 billion. The scandal forced a complete overhaul. In 2012, the UK government launched a review to reform the whole system. By 2013, there were new laws on the books making this stuff a specific crime. In 2015, Tom Hayes goes to jail. By 2023, LIBOR itself is finally put out of its misery and replaced. And then, the final twist. In early 2024, the Supreme Court overturns the whole thing. And look, this isn't just speculation. This is from the UK regulator's own official report on Barclays. It explicitly says the bank was manipulating submissions for profit and, crucially, to manage negative media perception during the crisis. This is proof the problem wasn't just a few rogue traders. It was a systemic failure, all the way up. And all of that brings us right back to our central mystery. With the convictions now in pieces, we're forced to look at what really happened here. Was this a clear-cut crime, or was it just the inevitable result of a completely broken culture? So, why was Tom Hayes' conviction quashed? It really came down to a critical legal argument. The Supreme Court found that the judge in the original trial gave the jury flawed instructions. He basically told them that if a trader took the bank's own commercial interest into account at all, it was automatically dishonest, automatically illegal. But the Supreme Court said, no, not so fast. They argued that since there were no explicit rules against it at the time, it wasn't automatically a crime, and that legal mistake was enough to make the conviction unsafe. It didn't mean the traders were innocent. It meant their trial was fundamentally unfair. So this leaves us with two completely competing stories. The first is the rogue trader theory, that guys like Tom Hayes were greedy outliers who broke the rules and got what they deserved. The other is the broken system theory, that the system itself was designed to fail. It had no clear rules, an obvious conflict of interest, and this whole practice was an open secret that management was fine with. In that version of the story, the traders were just doing what the system basically paid them to do. The banks paid billions for their failings, but the individuals who were prosecuted have now walked free. And it leaves us with this profound and, frankly, unsettling question about justice in finance. When a practice is so widespread that it becomes normal, where does corporate culture end, and where does a criminal conspiracy begin? And if the system itself is the problem, who, at the end of the day, should really pay the price?
So while markets rise and fall, systems like this quietly move billions behind the scenes, hidden from the public, hidden from scrutiny, and sometimes hidden from the law itself. Because in global finance, the most powerful forces are rarely the most visible. And this is just one of the systems used by the unseen elite.